Developing countries are adopting cryptocurrency faster than the West, and the world has barely begun to understand why. So today on HistoriNomica, we uncover the real economic forces driving this global shift and the historical patterns that explain it, starting with a surprising truth. Crypto is growing fastest, not in the richest nations, but in the ones facing the greatest financial struggles. And this story goes far deeper than hype or speculation, because it is rooted in currency instability, inflation, remittances, financial exclusion, and the long history of how people respond when traditional financial systems fail them. According to the 2023 and 2024 Chainalysis Global Crypto Adoption Index, countries like India, Nigeria, Vietnam, Philippines, Pakistan, Ukraine, Brazil, and Thailand rank at the top of worldwide crypto adoption, while the United States, United Kingdom, Germany, and Japan lag far behind. And the reason is economic reality. People in developing nations are not buying crypto to get rich. They are buying crypto to survive. Let's start with inflation, the silent thief that destroys wealth in dozens of countries. In Argentina, annual inflation crossed 140% in 2023, forcing citizens to find any store of value that wouldn't evaporate in a few months. In Nigeria, inflation rose above 30% in 2024, and the Nigerian naira lost more than half its value against the US dollar in less than a year. In Turkey, inflation surged above 60%, wiping out savings. In Venezuela, catastrophic hyperinflation destroyed the bolivar, with prices doubling every few weeks at peak crisis. Historically, when currencies collapsed like in Weimar Germany in the 1920s, Zimbabwe in the 2000s, or Yugoslavia in the 1990s, people always search for an alternative, usually foreign currency or physical commodities. But in the modern age, cryptocurrency became that alternative because it is borderless, accessible, and independent of local political instability. In Argentina, surveys show that more than 50% of citizens saving in foreign assets choose stablecoins like USDT or USDC, not cash dollars, because crypto helps them bypass government restrictions on buying foreign currency. This is not speculation, it is digital dollarization, a real economic phenomenon where citizens adopt stablecoins to protect themselves from inflation. Next is financial exclusion. Over 1.4 billion people worldwide have no access to bank accounts, and even more lack access to credit, savings accounts, or international payment systems. In regions like sub-Saharan Africa, traditional banking infrastructure is weak, expensive, or simply unavailable. For many people in Nigeria, Kenya, Ghana, and Ethiopia, opening a bank account is either too costly or requires documentation they cannot obtain. But with a $20 smartphone and an internet connection, they can download a crypto wallet and instantly access global finance. In fact, Africa has some of the highest rates of mobile money usage in the world, led by Kenya's M-Pesa system. And this created the perfect runway for crypto adoption. When people are excluded from the banking system, they do not wait, they innovate. Crypto became the first financial tool in history that allowed millions of unbanked individuals to store value, send money, and participate in the global economy without needing permission. Now let's talk about remittances, the lifeline of developing nations. In 2023, global remittances reached over $860 billion, with countries like India, Mexico, the Philippines, Nigeria, and Egypt receiving billions from workers abroad. Traditional remittance services, like Western Union or MoneyGram, charge 5% to 10% fees and take days to process transfers, draining money from families who already struggle to survive. Crypto slashes these fees and delivers money instantly. A Filipino worker in Dubai can send money home in seconds using USDT on blockchain networks like Tron or Stellar for a fraction of a dollar. A Nigerian living in London can send funds to family back home without paying high conversion fees. This is why the Philippines and Vietnam are among the world leaders in crypto adoption. Millions rely on cross-border payments, and crypto makes it cheaper, faster, and more reliable. Crypto solves a real problem, and where the problem is biggest, adoption is fastest. Beyond remittances, there is a deeper economic truth. Developing countries trust their governments and financial institutions far less than people in the West do. In Europe, the US, Canada, Japan, or Australia, systems are stable, banks are insured, and inflation is relatively low, so citizens feel no urgency to adopt crypto. But in many developing nations, corruption, unstable leadership, banking restrictions, and sudden currency devaluations create uncertainty. In Lebanon, banks literally froze citizens' accounts during the financial crisis, locking them out of their own money. Thousands turned to cryptocurrency to preserve savings. In Nigeria, cash shortages and withdrawal limits pushed millions toward stablecoins. In Pakistan, restrictions on foreign currency pushed traders and freelancers into using crypto for international payments. In countries where governments frequently devalue currency or restrict financial freedom, crypto becomes a tool of empowerment. History shows the same pattern. When institutions fail, people create alternatives. During the collapse of the Soviet Union, citizens used US dollars informally. During Zimbabwe's crisis, people turned to South African rand. During economic bans, black markets thrive. Crypto is simply the digital version of this historical behavior. People seek financial stability wherever they can find it. Another major driver is youth demographics. Developing nations have the world's youngest populations. In Nigeria, the median age is 18 years. In India, it is 28. In the Philippines, 25. While in Japan and Italy, it is almost 50. Younger populations are more open to technology, digital payments, online investments, and new financial systems. They are not attached to traditional banking because many never had access to it. In India, over 650 million people use digital payments, and UPI, India's instant payment system, processes more monthly transactions than all Western payment systems combined. This digital literacy naturally extends to crypto adoption. Meanwhile, in the US and Europe, older populations dominate and are more skeptical of digital currencies, slowing adoption. Another major factor is economic opportunity. Many people in developing countries use crypto to access global freelance jobs, play-to-earn games, digital assets, or investments that were previously unattainable. In Nigeria and the Philippines, millions participated in blockchain-based earning systems during the pandemic. In India, blockchain developers and crypto startups exploded in growth, attracting billions in venture capital before regulatory uncertainties slowed momentum. In Latin America, Bitcoin mining, staking, and DeFi platforms became paths to income where job opportunities were limited. To people in poorer nations, crypto is not a get-rich-quick scheme. It is often a get-out-of-poverty tool. Meanwhile, governments in developing countries have complex reactions to crypto. Some embrace it. El Salvador became the first country to accept Bitcoin as legal tender in 2021, aiming to reduce remittance fees and attract investment. The Central African Republic followed with its own crypto initiatives. But others impose restrictions. Nigeria repeatedly banned crypto banking, but could not stop adoption. India taxed crypto heavily, yet remains the world's largest adopter. China banned crypto trading, but still leads in blockchain patents and digital currency technology. Governments fear losing control over monetary policy, but they also recognize the economic potential. As the world transitions toward digital finance, many developing nations leapfrog traditional banking and go directly to crypto and digital currencies, just as they skipped landline phones and adopted mobile phones directly. This leapfrogging effect explains why African countries had advanced mobile money systems long before Europe or America. When a country has no legacy system holding it back, innovation moves faster. By contrast, Western nations have strong banking systems, stable currencies, and extensive regulations that slow innovation. Their citizens have less incentive to adopt crypto urgently. Developing countries adopt crypto because they must. The West adopts it only if they want to. Finally, the future. Analysts from the World Bank, IMF, and major blockchain research firms predict that crypto adoption will continue accelerating in developing nations for 5 reasons: high inflation, weak currencies, expensive remittances, young tech-savvy populations, and financial exclusion. These factors are not temporary. They define the economic reality of billions. Crypto is no longer a niche investment. It is becoming the financial infrastructure for people who are excluded from the old system. In the future, global economic power may shift toward nations that embrace digital finance early, just as industrial power shifted during the Industrial Revolution. For millions across Asia, Africa, and Latin America, crypto is not just money. It is freedom, opportunity, and survival. And history tells us that when a new financial technology solves real-world problems, it doesn't just grow, it transforms the world. If you enjoyed this deep investigation into why developing countries are embracing crypto faster than the West, remember to like, share, and subscribe to HistoriNomica, where we uncover the hidden forces shaping global finance and history. Your support helps us bring more powerful stories, data-driven insights, and untold economic truths to the world. Thanks for watching, and I'll see you in the next video.